Look, I need you to understand something that most financial advisors won't tell you. We're standing at a moment in history that only comes around once every few decades. And if you're within 10 years of retirement, or already retired, what happens in the next 12 to 18 months could determine whether you live comfortably or struggle through your golden years. I'm talking about gold, but not the way you've heard about it before. See, there's this narrative that gold is just a hedge, a boring insurance policy you tuck away and forget about. That's what they want you to think. Because if you understood what's actually happening right now, behind closed doors, in the vaults of central banks and the trading floors of institutions that move billions, you'd realize we're not looking at a hedge anymore. We're looking at the single most important wealth preservation move you can make. Let me show you what I mean. Right now, as we speak, central banks around the world are buying gold at a pace we haven't seen in over 50 years. We're talking about 410 tons purchased in just the first half of this year alone. That's 24% above the 5-year average. These aren't small players. These are the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the institutions that control trillions in assets. And here's what's fascinating. They're not buying because gold looks pretty. They're buying because they see something coming that most retail investors are completely blind to. Think about it. When was the last time you saw central banks agree on anything? They compete. They manipulate currencies against each other. They play geopolitical chess with interest rates and bond yields. But on gold, they're unanimous. They're accumulating like their economic survival depends on it, because it does. Now, you might be thinking, okay, but what does that have to do with my retirement account? Everything. Let me paint you a picture. Imagine you're 62 years old. You've worked your entire life. You've got maybe $800,000 in your 401k. You've been told to keep it in a balanced portfolio, 60% stocks, 40% bonds, the traditional advice, the safe advice. But here's what nobody tells you. That advice was built for a world that doesn't exist anymore. It was built for a world where the dollar was backed by something real, where inflation stayed around 2%, where governments didn't print money like it was going out of style. That world ended in 1971 when Nixon closed the gold window. And it's taken 50 years for the consequences to fully play out. But we're here now. We're at the end game. Look at what's happened to the purchasing power of the dollar since then. It's lost over 97% of its value. That means the dollar you earned in 1971 is worth about 3 cents today. 3 cents. And the pace of that decline is accelerating. You know what hasn't lost value? Gold. In fact, gold has surged over 30% just this year. It's hit record highs, breaking through every resistance level that technical analysts said was impossible. And it's not slowing down. Goldman Sachs just came out with a forecast that has the gold market buzzing. They're projecting gold at $4,900 per ounce by the end of next year. That's not some fringe conspiracy theorist. That's Goldman Sachs. The same institution that has access to data and modeling that you and I can only dream about. But let's dig deeper. Because the price movement is just the symptom. The real story is what's driving it. There's this concept called de-dollarization. It sounds technical, but it's actually pretty simple. Countries around the world are losing faith in the US dollar as the global reserve currency. And they're moving their reserves into gold. Why? Because they've watched what happened over the last few years. They've watched the US government add trillions to the national debt. They've watched the Federal Reserve print money to bail out banks and fund stimulus programs. They've watched inflation spike to levels we haven't seen in 40 years. And they've realized something terrifying. The dollar is a liability, not an asset. So they're buying gold. China's been doing it quietly for years. Russia accelerated their purchases after sanctions were imposed. India, Turkey, Poland, Singapore. The list goes on. These countries are building gold reserves because they know that when the next financial crisis hits, and it will hit, the dollar won't be the safe haven it once was. Now, here's where this gets personal for you. If you're holding your retirement savings in dollar-denominated assets, stocks, bonds, cash, you're essentially betting that the dollar will maintain its value. You're betting that the same government that's $35 trillion in debt will somehow figure out how to stabilize the currency. You're betting that inflation will magically go back to 2% and stay there. That's a bet I wouldn't take. And clearly, central banks aren't taking it either. Let me tell you a story. Back in the 1970s, there was a period that economists call the Great Inflation. Oil prices spiked. The cost of living doubled. People who had saved their whole lives watched their purchasing power evaporate. But there was a group of people who didn't just survive that period. They thrived. They were the ones who had moved a portion of their wealth into gold. Because while the dollar was collapsing, Gold went from $35 an ounce in 1971 to over $800 by 1980. That's a 2,200% return. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying the conditions are eerily similar. We've got massive government debt. We've got central banks printing money. We've got geopolitical tensions rising. We've got inflation that's proving far stickier than anyone expected. And we've got gold breaking out to all-time highs. Here's something most people don't understand about gold. It's not just a commodity. It's not like oil or wheat or copper. Gold is money. It's been money for 5,000 years. Every major civilization in human history has recognized gold as a store of value. Why? Because you can't print it. You can't create it out of thin air. You can't devalue it with a policy decision. It exists in finite quantities, and it takes real resources to extract it from the ground. That's why central banks hold it. That's why it's on their balance sheets as a Tier 1 asset. Because when everything else fails, when currencies collapse and governments fall, gold remains. And right now, we're seeing something unprecedented in the gold market. There's a structural shift happening between paper gold and physical gold. Let me explain. For decades, the gold market has been dominated by paper contracts, futures, options, ETFs. These are essentially IOUs for gold. You don't own the physical metal. You own a promise that someone will deliver it to you if you ask. But here's the problem. There's way more paper gold than there is physical gold. Some estimates put the ratio at over 100 to 1. That means for every ounce of physical gold that actually exists, there are 100 paper claims on it. This works fine as long as everyone's happy holding paper. But what happens when people start asking for delivery? What happens when investors realize that their gold ETF might not actually have the gold it claims to have? We're starting to see the cracks. Physical gold premiums are rising, delivery delays are increasing, and the spread between paper gold prices and physical gold prices is widening. This is what's called a squeeze. And when it fully plays out, the price of physical gold is going to explode. Think about it from a supply and demand perspective. Gold production has been relatively flat for years. The easy gold has already been mined. New discoveries are rare. And it takes years, sometimes decades, to bring a new mine online. Meanwhile, demand is skyrocketing. Central banks are buying. Institutional investors are buying. Retail investors are waking up and buying. And there's only so much gold to go around. What happens when demand massively outstrips supply? Prices go up, way up. Now, I want to address something that I hear all the time. People say, but gold doesn't pay dividends. It doesn't generate income. Why would I hold it in my retirement account? Here's the answer. Gold's job isn't to generate income. Gold's job is to preserve wealth, to maintain purchasing power, to protect you when everything else is falling apart. Let me give you an example. Let's say you had $100,000 in the stock market at the beginning of 2008. By March 2009, that was worth maybe $50,000. You lost half your wealth in a matter of months. But if you had that $100,000 in gold, gold actually went up during that period. It went from around $800 an ounce to over $1,200 by 2011. You didn't just preserve your wealth, you grew it. And here's the kicker. If you're retired or close to retirement, you don't have time to recover from a market crash. If you're 30 years old and the market drops 50%, okay, you've got decades to make it back. But if you're 65 and the market crashes, you're selling assets at the bottom to fund your living expenses. You're locking in losses. You're destroying your retirement. That's why gold matters. It's the asset that zigs when everything else zags. Now, quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about. It's called a gold IRA. Basically, it's a way to hold physical gold inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how it works. It's in the description below. Covers the whole process, the rules, the benefits. Worth checking out if this is relevant to your situation. All right, back to what's happening in the market. There's another piece of this puzzle that most people aren't paying attention to. It's the COMEX. That's the commodities exchange where gold futures are traded. And there's something very strange happening there right now. The amount of gold available for delivery at the COMEX has been dropping. We're talking about inventories that are at multi-year lows. At the same time, the number of contracts demanding delivery has been rising. This is a powder keg. Because if there's not enough physical gold to satisfy delivery demands, the whole paper gold system could implode. Prices would have to rise dramatically to either bring in more supply or discourage delivery demands. And here's what makes this even more interesting. There are rumors, and I want to be clear, these are rumors, but there are persistent rumors that some of the gold held in COMEX warehouses has been leased out multiple times, meaning the same bar of gold has been promised to multiple parties. If that's true, and if those parties all demand delivery at the same time, we're looking at a default scenario, a failure to deliver. And that would send shockwaves through the entire financial system. Now, whether that happens or not, I don't know. But the fact that it's even a possibility should tell you something about the fragility of the current system. Let's talk about another angle, the geopolitical situation. We're living in a world that's becoming increasingly multipolar. The US is no longer the unquestioned hegemon. China's rising. Russia's asserting itself. The BRICS nations, that's Brazil, Russia, India, China, South Africa, are forming economic alliances that bypass the dollar. There's even talk of a BRICS currency backed by gold. Now, whether that actually happens is anyone's guess. But the fact that it's being discussed at the highest levels of government tells you where the world is heading. Countries are tired of being subject to US monetary policy. They're tired of having their assets frozen or sanctioned because they don't toe the line politically. And they're looking for alternatives. Gold is that alternative. It's neutral. It's not controlled by any one country. It's universally accepted, and it can't be sanctioned or seized as easily as dollar-denominated assets. This is why central banks are accumulating. They're preparing for a world where the dollar is no longer king. And they want to make sure they have real assets, tangible assets, when that transition happens. Now, let me bring this back to you in your retirement. You've probably been told to diversify. Don't put all your eggs in one basket. That's good advice. But here's what most financial advisors mean by diversification. They mean own a mix of stocks and bonds, maybe throw in some real estate or commodities. But that's not real diversification, because all of those assets are denominated in dollars. They're all subject to the same systemic risks. If the dollar collapses, if the financial system seizes up, all of those assets are going to suffer. Real diversification means owning assets that are outside the system, assets that don't depend on the solvency of banks or the stability of governments, assets like physical gold. And I want to emphasize the word physical, because there's a big difference between owning a gold ETF and owning gold bars or coins that you can hold in your hand or store in a secure vault. With an ETF, you're trusting that the fund actually has the gold it claims to have. You're trusting that in a crisis, you'll be able to redeem your shares for physical metal. You're trusting that the counterparties in the system will honor their obligations. With physical gold, you don't have to trust anyone. You own it. It's yours. And no matter what happens in the financial system, you have that wealth. Now, I know what some of you are thinking. This sounds like doom and gloom. Are you saying the whole system is going to collapse? Not necessarily. But I am saying the system is under stress. I am saying there are cracks forming. And I am saying that the people who are in the best position to know, the central bankers, the institutional investors, the sovereign wealth funds, are taking action to protect themselves. Shouldn't you be doing the same? Let me give you another historical example. In 2008, we had a financial crisis that almost brought down the entire global banking system. Lehman Brothers collapsed. AIG had to be bailed out. The stock market crashed, but that crisis was contained, relatively speaking. Governments stepped in with massive bailouts. Central banks printed trillions of dollars. They kicked the can down the road, but here's the thing. They didn't solve the underlying problems. They just papered over them. The debt is still there. In fact, it's much bigger now. The imbalances in the system are still there. They're worse. And the tools that central banks used in 2008, the bailouts, the money printing, the zero interest rates, those tools are less effective now because we've already used them. The ammunition has been spent. So what happens when the next crisis hits? What happens when the system seizes up again and central banks don't have the firepower to fix it? That's when gold really shines. Because gold doesn't need a bailout. Gold doesn't need a central bank to support it. Gold is the ultimate safe haven. And the smart money knows this. That's why they're accumulating now, before the crisis hits. Because once the crisis is here, it's too late. Prices will have already spiked. Availability will be limited. You'll be competing with everyone else who suddenly realize they need protection. The time to act is now. While gold is still available, while you can still move assets into a gold IRA without triggering a panic, while you can still get physical metal at reasonable premiums. Let me share one more thing with you. There's a concept in investing called asymmetric risk. It means the potential upside far outweighs the potential downside. With gold right now, that's exactly what we have. If I'm wrong, if the dollar remains strong, if inflation comes down, if the financial system stabilizes, what's the worst that happens? Gold maybe goes sideways. Maybe it dips a bit. But it's not going to zero. It's not going to lose 90% of its value. But if I'm right, if the trends we're seeing continue, if the dollar weakens, if inflation persists, if geopolitical tensions escalate, gold could double, triple, or more. We could see the kind of moves we saw in the 70s. We could see gold at $5,000, $6,000, even $10,000 an ounce. That's asymmetric risk, limited downside, massive upside. And for someone in or near retirement, that's exactly the kind of risk profile you want. You can't afford to gamble with your life savings. You need protection. You need assets that will preserve your wealth no matter what happens. Gold gives you that. It's been doing it for 5,000 years, and it's going to keep doing it. Now, I want to be clear about something. I'm not saying you should put 100% of your retirement into gold. That would be foolish. Diversification is still important, but I am saying that if you don't have any gold in your retirement portfolio, you're taking a massive risk. You're betting everything on the continued stability of a system that's showing clear signs of stress. Most experts recommend somewhere between 10 and 20% of your portfolio in precious metals. Some go higher, especially in times like these. But even 10% can make a huge difference. Let's do some quick math. Say you've got $500,000 in your retirement account. 10% would be $50,000 in gold. At current prices, that's roughly 12 to 13 ounces. Now, if gold goes to $5,000 an ounce, which is not unrealistic based on Goldman Sachs' projections and historical precedent, that $50,000 investment becomes over $60,000. You've made $10,000, and more importantly, you've protected that portion of your wealth from dollar devaluation. But here's the real benefit. While your stocks and bonds might be getting hammered in a crisis, your gold is holding steady or going up. It's providing balance. It's giving you options. It's allowing you to weather the storm without having to sell other assets at a loss. That's the power of gold in a retirement portfolio. It's not about getting rich quick. It's about preserving what you've already built. It's about making sure that the decades of work you've put in, the sacrifices you've made, the money you've saved, actually mean something when you need it most. And let me tell you, there's nothing worse than watching your retirement savings evaporate because you didn't take action when you had the chance. I've seen it happen. I've talked to people who lost half their nest egg in 2008 and never recovered. People who had to delay retirement, go back to work, downsize their dreams. You don't want to be that person, and you don't have to be. The information is out there. The warning signs are clear. Central banks are showing you exactly what they're doing. The smart money is positioning itself. The question is, are you going to pay attention? Because here's the reality. This turning point, this moment we're in right now, it's not going to last forever. Windows of opportunity close, and when they do, the people who didn't act are left scrambling. I've seen it happen over and over again in markets. People wait. They hesitate. They think they have more time. And then suddenly, the opportunity is gone. Prices have moved. Availability has dried up. And they're left wishing they had acted when they had the chance. Don't let that be you. Your retirement is too important. Your financial security is too important. Your peace of mind is too important. Gold gives you that security. It gives you that peace of mind. It gives you the confidence that no matter what happens in the world, no matter what crazy policies governments implement, no matter what crises emerge, you have real wealth. Tangible wealth. Wealth that has stood the test of time. And right now, you have the opportunity to secure that wealth. To move a portion of your retirement savings into an asset that central banks are fighting to accumulate. To position yourself ahead of the crowd. The guide I mentioned earlier, the one about gold IRAs, it walks you through the entire process. How to set up the account, how to fund it, how to choose the right metals, how to store them securely. All the details you need to make an informed decision. It's free. It's in the description. And it could be the most important financial decision you make this year. Because when I look at everything that's happening, the central bank buying, the geopolitical shifts, the monetary instability, the technical breakouts in gold prices, I see a perfect storm forming. A storm that's going to reshape the financial landscape. And the people who are prepared, the people who have positioned themselves correctly, are going to come out ahead. They're going to preserve their wealth. They're going to maintain their standard of living. They're going to retire with dignity and security. The people who aren't prepared, they're going to struggle. They're going to watch their purchasing power decline. They're going to make difficult choices about their lifestyle and their future. Which group do you want to be in? The choice is yours. But the time to make that choice is now. Not next month. Not next year. Now. Because this turning point, this critical moment in financial history, it's happening right now. And your retirement depends on how you respond to it.